morning and welcome everybody. Thank you for joining us today. I hope you're enjoying the conference and have tried the networking portion of the platform. My name is Christine Simpson. I'm an assurance partner based in Vancouver and the leader of our not-for-profit sector in BC. It's my pleasure today to introduce Jean Pritchard. Jean has over 25 years of experience in public accounting and focuses on finding practical solutions to challenges organizations face on a daily basis. She's also currently the treasurer of the United Way Community Service of Guelph and Wellington County and treasurer of Centre Wellington Community Foundation. There's no better person I can think of who could talk about financial literacy for the NPO board, but my colleague Jean. So I'm going to hand it over to Jean, and at the end we'll try and have some questions to engage on. Go ahead.
Great. Thank you, Christine. I'm just going to share my screen with everybody. Hopefully that's working okay. There's always that moment of panic. Will my screen show correctly? But hopefully you're all seeing it now. So good morning, everybody. Thanks so much for joining us today. I just want to encourage you to use the chat function over on the side. Christine and I are going to be looking at the questions at the end, and we're going to be happy to try to answer as many as we can. So please go ahead and post them as you think of them. So as Christine said, I've had a long involvement with charities and not-for-profits, and my involvement actually started in the sector when I was a teenager as an employee of a charity. Since then, I've sat on several boards. CPA, I always seem to wind up being the treasurer, as you can imagine, kind of a thing for CPAs to always be the treasurer. And of course, as part of my professional life, I've worked with many boards of directors over the years on governance and lots of other issues. And the one thing that I hear over and over from them is that they often struggle with asking the right questions when it comes to dealing with the financial aspects of their role. So here we are today. And board members are so essential to the ongoing success of a not-for-profit, and supporting the management of the financial piece of that is one of the most basic and fundamental functions. And in order to do that, we need to start with sort of the root financial statements and how they work. And from there, we can build all the pieces of the financial puzzle together. So let's take a look at what we want to cover today. We're going to chat a bit about industry challenges and the responsibilities of the board. And then we're going to talk about some very basic financial statement principles, as well as a concept that is crucial for proper accounting. And it sounds really geeky, but these things are really important to us. It's important, it should be important to you too, and that's the accrual basis of accounting. So we'll delve into that a little bit. And finally, we're going to touch on how to help your organization plan ahead and talk a bit about management and oversight. So first up, we have the challenges inherent in the not-for-profit industry. So we all have different reasons for joining boards of directors, and of course, we all bring different skill sets to the boardroom table. And it would really be unrealistic to expect everyone to come from a financial background. So we expect, and it's common, for board members to struggle a bit with the financial piece of their role. And the biggest problem with this is that it can mean that a board member can find it really difficult to ask or maybe have the confidence to challenge the management of the organization when something looks kind of off. And the board member may even get to a point where too much time has passed to ask basic questions about the organization. And then if you think about one of the roles of the board being to plan for the future, if kind of the basic fundamental backdrop isn't there, it can make that planning piece even more difficult. Another thing to think about is that not-for-profits have some very particular nuances when it comes to their accounting and the reporting to the government that they're required to do. So in terms of the accounting part, they must follow a particular set of rules called accounting standards for not-for-profit organizations. And these are reasonably different than the rules applied in the for-profit world. And then we have the issue of the tax returns and charity return. The charity return, as you know, gets posted to the CRA website. So making a mistake in filling that return out can have some very embarrassing consequences. This morning, Bruce talked a lot about accountability and how more important than ever that is. And, you know, this all kind of boils down to that same concept. There are also some practical issues that we face in our sector. And many of us are part of small organizations, and we may have very limited resources when we're thinking about our administrative support. In fact, on many boards, the treasurer is actually doing the bookkeeping. I'm in that situation myself right now for one of the organizations that I work with. And of course, this can affect the quality of the financial reporting on a month-to-month basis. Treasurers change, they come and they go. And if it's a small organization, you get different mindsets on how things are done and how things should be done. And this can make it really hard to have any continuity at all. The board is often very hands-on in helping to run the organization, which can really result in a lack of perspective on financial decisions. It's the old can't see the forest for the trees syndrome. It can be really hard to step back and look at issues critically and objectively when you are buried deeply in the day-to-day details. And finally, there's always the F word. And I know it's a hard word to hear, but fraud is always an area of concern for us. Boards need to be thinking, and it's more and more true every day, how to protect their organization from the risks of fraud. The policies and procedures that you set in place and then enforce are so important. And there's a thinking ahead component to this as well. So as things progress in our new world, we're going more and more digital. We're using things like online banking more and more, and we need to be constantly thinking ahead as we implement these new tools as to how they're going to affect our control systems. I do want to take a second and just talk about board orientation practices. So I always think that it takes a full financial cycle for a new board member to be fully up to speed on all of the pieces of the organization. So this includes the human resources issues, the finances, the politics at the boardroom table, and everything else that will help you be a good board member and help the board make good decisions. And one thing that can really shorten this cycle of understanding is having a good orientation process. And many of you, I'm sure, belong to organizations where this is done well and is part of your kind of onboarding process. But it's always good to step back and think about it and think what a new board member needs to know. It's so much easier for a new board member to ask the so-called dumb questions. And for the record, there are no such thing as a dumb question, but it's easier to ask those questions at the beginning of their tenure rather than later on. So making sure that your orientation process addresses everything, including the financial piece, is really key. So I always think that walking through the last set of audited or whatever the year-end financial statements were, and then reviewing the monthly or quarterly board package and really delving into some of the details is a key aspect of this orientation. So let's revisit the responsibilities of board members. And there are many, but the overarching responsibility of each board member is to enable the organization to deliver on its goals and remain able to do so into the future. And we each have a fiduciary responsibility to safeguard the mission of our organization, whether that's a charitable mission or the mission of a sports organization, it doesn't matter. That's at the end of the day, that's our job. So the financial oversight piece is firmly in your hands. And you also must take care of things like strategic planning, looking at the organization's purpose periodically, and then keeping an eye on the priorities and the fundraising initiatives. If you have management in your organization, you may not, but if you do, then management is responsible for executing the plan, but the board must approve and monitor the plan. And who are we responsible to? It's always good to remember that. This is going to be all of your stakeholders. So your donors, your program users, your members, your volunteers, and if you have them, employees and clients. You have to be able to provide them with appropriate and relevant information on an ongoing basis. And let's talk about some of the more scary stuff too. There are actual legal responsibilities that come along with being on a board. And there are quite a few of these too, but wearing my finance hat, some board members that I've talked to aren't aware that they can actually be held personally responsible by the government if things like employee withholdings or HST are not paid properly. So that's a scary thought. So another incentive for us to be monitoring what's happening all the time. If the board is always focused on minimizing the risk of errors and making sure there are sufficient resources available, then we're all going to sleep a bit better at night. All right, let's delve into the basics. We're going to look at some financial statement terminology to start. And some of you may be familiar with this, and if you're the member of the management of a board, then certainly you can be thinking about this in terms of how to onboard new board members in your organization or how to bring people up to speed if you feel like there's a gap in knowledge. So let's start with the balance sheet. So the balance sheet in the not-for-profit world is often named the statement of financial position. And it's a snapshot. So it's important to remember that it's just a snapshot at a point in time of everything that the organization owned and everything that it owed at the year end or the month end or the quarter end, depending what the period is that you're looking at. Assets are just what they sound like. So they're the things that are owned by the entity as at our snapshot date. So this is going to include your liquid things like cash and your investments, and maybe you have some accounts receivable. But it's also going to include some less liquid things like your physical assets. So computers, land and buildings, furniture, those sorts of things. And when you're thinking about these, physical things, it's important to note that under the accounting rules for not-for-profits, these things have to be reported at their original cost. So a question that I get a lot when we're looking at a balance sheet with land and buildings on it is, how come it's only on there for $300,000? I heard it's worth about $1 million. Well, that's because we're not allowed to report at the fair market value. And there are good reasons for this. Back in the 80s, companies, not so much not-for-profits, but back in the 80s, companies were allowed to write these types of assets up and down. And we all know what happened sort of at the end of the 80s and into the 90s. A lot of property values went way down, and a lot of decisions had been made based on information that was just plain old wrong and not realizable. Land and buildings aren't very liquid, so we can't easily turn them into cash to use for our operations, and we could make some bad decisions if we're seeing those swings. Investments have different rules, so I'm going to contradict everything that I just said. So investments are actually, if your statements are audited or reviewed, they're actually reflected at their fair market value for the most part. And this is because they're more liquid than, say, a building. We do need to be careful when we're thinking about our investment gains that we're looking at and thinking about and taking into account realized gains versus unrealized gains. That's a pretty important distinction. So then we have our liabilities. So these are obviously the obligations the organization has at the reporting date. This includes things like our accounts payable, our payroll remittances, I talked a bit about that earlier, our HST if we owe some, and then any other debts that we have. It will also include deferred revenue, which we're going to talk a little bit more about when we look at our accrual basis of accounting slide. And then what do we have left? So we have our net assets. Our net assets are what is left over if we subtract our liabilities from our assets. And the theory is that if we were to liquidate all of our assets at their book value, pay all of our obligations, we would have our net assets at the end. The second component you will commonly see in your financial statements is your income statement. Sometimes this is called the statement of operations, and it details all of the inflows of various types of income and then all of the expenditures made related to keeping the organization running. You'll see a lot of variations in how this is presented. For example, for year-end purposes, some organizations will actually choose to present this information based on the programs that are running. So you might see line items on your income statement that say things like children's program expenses or housing initiative expenses, rather than telling you exactly what that money was spent on. For management purposes, though, you're probably going to want to see what we actually spent the money on. So wages, supplies, travel, professional fees. So these are the actual expense line items that you're going to want to use when you're budgeting and when you are delving into the details behind your year-end statements. Next concept on the list is profitability. So net income, same thing. It's the excess of your revenues over expenditures, or maybe a bit less happily the other way around. It's what's left over after everything has been spent and brought into the organization. The surplus or the deficit that we're left with is then added to or subtracted from the net asset figure that we discussed earlier. So I'm going to move on now and talk about my favorite subject. No, not really, but it's important. It's the accrual basis of accounting. So the accounting concepts that we use to produce accurate and useful financial statements are very important, and there are many of them. Trust me, the book that we use to determine how we have to account for things is getting bigger by the year, not smaller. But one of the most important ones is the notion of the accrual basis of accounting. So financial statements are typically organized in one of two ways, either according to a cash basis or according to an accrual basis. And it's important to know which method is being used when you're looking at financial information. So if you're looking at a set of audited statements, they have to be, with pretty much zero exception, presented in accordance with the accrual method. But if you're looking at internal statements, so management produced statements, they may not be produced according to the accrual basis. They may well use the cash basis. So it's always a good question to ask when you're presented with a pile of paper to look at. So what's the difference? Under a cash basis of accounting, revenues and expenses are recorded when the cash is actually received or actually paid out. This is super simple. It's easy to understand. It's easy to administer. And understanding our cash flow is an important concept when we're running an organization, but it probably isn't going to result in financial statements that are reliable for making decisions. So let's think about the accrual basis of accounting then. Under this basis, the revenues and expenses are recorded in the period they are earned for revenues and incurred for expenses. So that's an important distinction. So we may well earn some revenue in a let's say a month. We may have provided a service, but we may not actually get the money for that service until a later time. On the other side of the coin, we may receive shipment of a big batch of computers on November the 30th, but we may not have to pay for that until December. So you can see that the cash doesn't necessarily equate to when we are being able to use an asset or when we've been earning our revenue. So when we apply this concept, it allows us to match the revenues and the expenses together so that we can see really thoroughly and to the finest detail whether or not we are behind or ahead of the game in terms of what's happened from a financial reporting perspective. And I'm going to give you an example of where things can go wrong if we do not use this basis of accounting. So imagine that your organization has a year end of December the 31st, 2020, and say that on December the 20th of 2020, you receive a payment related to a large grant that has been given to your organization to run a program in 2021, so next year. If you use the cash basis of accounting, you would be recording that revenue on your December the 31st, 2020 financial statements. So this would make your revenues look nice and high, and you wouldn't have any expenses yet to match off against it. So you might look at your bottom line and think, yeah, we broke even this year, or even better, we showed a nice profit. But now in 2021, we have to deliver that program with no matching revenues. The revenue's already gone, we've accounted for it. And now we just have a big list of expenses that we have to spend money on to deliver the program. So you can see how this might make us make a mistake when we're making decisions around how we've done and how we're going to do next year. In my example, if we had used the accrual method of accounting, we would have removed that grant revenue from your income statement for 2020, and we would have actually shown it on your balance sheet as a liability because we now have an obligation to expend those funds in a future year. So it's a liability. So in this way, your income statement now shows the reality of the year that was 2020, and it also reflects the fact on your balance sheet that you have an obligation to spend the money in the future. All right, and I see some great questions popping up, so I will be looking at those with Christine when we get to the end. Let's talk a little bit about your audited financial statements. So many organizations must have an audit. Some get a review, and some are small enough that neither are applied to them yet. But we're going to talk about the audit just to kind of put you in the frame of mind that hopefully your organization will be in once it gets to the audit stage. So when you're presented with a set of audited financial statements, what should you see? And I have a slide here. So here are the things that you should see. So you should see the independent auditor's report, the statement of financial position, which we just talked about, the statement of operations, a statement that reconciles the change in the net assets or the fund balances, a statement of cash flows, and then some notes. Let's talk about the auditor's report first, though. So the first opinion in the auditor's report is really the key one. And it tells you whether or not the financial statements have been properly presented. And you will see two variations on this in general. One will say qualified report, and one will not have the word qualified in it. So ideally, we live in a world where all of our audit reports are unqualified, so they don't have that qualified piece at the beginning. But in a charity in particular, you will quite often see a qualified audit report. And the reasons for this can be many, but in general, it's because the organization runs some fundraising activities which can't be satisfactorily or effectively audited. So the auditor would have to stand over the shoulder of every person involved in a fundraising activity for 365 days a year, and no one wants to pay for that, and it's just not practical. So seeing that qualified word is not something to be concerned about, but you should thoroughly read the audit report to make sure you understand what the qualification is for. Now, we already talked about two of the statements here in the list, but let's just quickly touch on the other ones that we didn't talk about. So the statement of changes in fund balances takes that net income or net loss that we arrived at on our income statement, and it adds or subtracts it from the net assets the organization had at the beginning of the fiscal year. And then the cash flow statement. So it's just what it sounds like. It takes our opening bank balance in the year, adds and subtracts all of the incoming and outgoing cash, and then tells us what our closing cash balance is. So it shows us where everything came from and where everything went from the perspective of our financial records. And finally, we have the notes to the financial statements. And whenever I present a set of financial statements at an AGM or to a board, I always tell the audience that they should look at the notes probably before they even look at the numbers. And that's because the notes provide a lot of explanatory information about how things have been accounted for. So for example, you would go to the notes to find out what kinds of investments an organization has, or what its accounting policy is on when it recognizes its revenue, or maybe if there's a line of credit or some other loan available for use. All right, so let's spend some time on planning ahead. As a board member, you're going to be an integral part of the process to think about the future of your organization. And the session before this, there was quite a bit of conversation about the concept of strategic planning. And you're going to be thinking about the next few months, the next few years, and maybe even beyond that when you're having these discussions. But from a financial perspective, here are some things to think about. So cash flows are always top of mind, especially when times are harder. And many of us are going through a time that's a little bit more challenging right now in terms of being able to pay our bills. If you have really good, solid financial reporting as the basis for your cash flow thoughts, then you're going to be much better off. You're going to be thinking about how and when the cash comes in and out of the bank. Using a cash flow projection report to forecast this is a really helpful tool. And once you've developed the tool, you can keep using it for quite a while. So it's definitely worth putting in the time. And then as a board, once you see holes, you can problem solve them. So do we need to run an extra fundraiser, or do we need to defer a program or a purchase that we planned on making? Targets and budgets. So targets for fundraising will need to be set or approved and then managed by the board. The budget piece is so important. I can't emphasize that enough. It's a guide that everybody's going to follow for the operations of the organization. And as a board member, it's one of the best ways you have to monitor progress as the year goes on. Management ideally would develop that budget, and then the board would review and question and ultimately approve it, kind of going back to my forest for the trees thought from earlier. And then management has, of course, a great blueprint to follow for the rest of the year. Issues pop out really quickly once you're doing a budget to actual comparison. Records and tracking are another area where, as a board member, you're responsible and where you should be paying attention and asking questions pretty much constantly. Government audits from the CRA can happen anytime, and there are really strict rules about how records and books must be maintained and how things like invoices and charitable receipts must look. And you're going to want to be checking as a board member that these things are being done properly. Your auditor, if you have one, is a great resource if you're wondering about proper practices, and asking a lot of questions, again, is key here. Things like check signing, banking, retention of records, and then looking at how online activity impacts your organization are always going to be top of mind. We've talked a lot today, the previous speakers have, around digitization and how the digital world is becoming more and more important for us, and our computer systems in our world must be very carefully safeguarded against hacks and ransom attacks. We've all heard horror stories recently about these things happening. And in our pandemic world, we're going to be changing how we do things. I think we're going to be seeing a lot of opportunities in the digital functionality of our systems, but of course this also raises more risks. So we need to be really careful that we're thinking about this at the board table. And our last slide here before we go to our questions. So monitoring, I have a bit of a checklist here, sort of 5 top things to be thinking about as you're thinking about your role. So number 1, monitoring performance. So I've talked a lot about budgets. We've talked a lot about budgets in general today. Looking at your internally generated financial statements and asking lots of questions to challenge assumptions is key. Number 2, managing the audit or review at the end of the year. The members of the board have to give the final sign-off, the final approval on the audit or review. And one thing that some boards aren't aware of is that you really should be meeting with your auditor face-to-face at some point during that process. It's really important to have open lines of communication. Number 3, filing correctly. So filing your tax return, filing your charity return correctly, very important. The risk of reputational damage is super high if we make an error. Number 4, divide and conquer. There's so much work to be done. Helping out with the finance piece, even if you're not the treasurer, is a great way to make sure things are being done in a good way and that you understand the ins and outs of everything that's going on. And it's also fun. Believe it or not, it's also fun. And the last one is staying transparent. So making sure that the information is available for your stakeholders and that you're able to stand up and look at them in the eye and understand that it's been presented accurately to make you sleep a lot better. So thanks so much for your time today. I hope I've given you some things to think about. We're going to take a look at our questions and see what we've got. So I'm going to stop sharing my screen, Christine.
Sure. Thanks, Jean, for a great presentation. I looked at all the questions and I've tried to tackle the ones that I'm hearing as well. A lot of organizations are having unusual surpluses this year. So they might have donations that they didn't expect. The timeliness of them is inconsistent and may have surpluses. So the concern is how do I articulate this to donors so they don't think I have too much money? And so maybe if you can comment on that.
Yeah, so I mean, yes, it's funny, when we went into this pandemic, I don't think we at the beginning thought this would be something we'd be worrying about, but it is. So there are a couple of thoughts I have. So if your donors are giving you money that is to be used for a specific program that's going to occur in a future year, then as I said, when I was talking about that whole accrual basis of accounting, that's where you might be wanting to think about what program the money was earmarked for. If it's just a donation that's been given for the use of the organization for its discretion, then you're right. Telling that story is going to be really important. We don't want our donors to think we don't need their money. So I think having a good document that goes along with our financial statements and always talking to our donors and making sure they understand that, things look okay right now in our organization, but we're expecting even more demands of us in the coming months. So being able to articulate that, I think, is really important. But talking to your auditors about future programming and whether there's an opportunity to defer some of these revenues might be the place to start.
And that did lead into some of the other questions as well. One of the questions was around how do we focus on accrual accounting when we have multiple funders who have different year ends? So how do we make sure we satisfy all those different funders in reporting?
Okay, so that's a good question. So when we receive funding from different organizations, we always have a contract. Well, usually we'll have a contract or an understanding with them about when we're supposed to be using this money. So you could have 2 or 3 funders who have different year ends, but when we're looking at your organization side of it, and when your auditor is looking at your side of it, what we're worried about is when are you supposed to spend this money? We don't really mind about what the year end of your funding organization is. We're worried about your year end, and we're worried about when you are supposed to be spending this money. So that's kind of where we start looking at things. And then we look at our accrual basis of accounting rules and we say, okay, well, this organization said this money's for 2021. This other organization said it's for 2021 and half of 2022. So then we start moving everything around so that everything ends up in the right financial period from your organization's point of view. We're not so worried about what the funding organization's year end is, but we're worried about yours and making sure your statements are accurate. Hope that helps. Christine, you're muted somehow.
Improve volume. We're not only focused on year end, but months and quarters as well, and making sure we're keeping up on
right.
That.
Yeah.
So
we want to hone in very specific.
And I have another question that's probably relevant for all of us: is how do you balance the cost of an accountant when you have very limited resources and you're a small NPO? Why is it important to spend money on a good accountant?
Yeah, that's a good question. And, and it is hard to rationalize if you're a really small organization with small revenues. It can really, put a big line item on your budget to think about an accountant. But I think the benefits are many. So, you've heard a lot of things today about making good decisions and having good systems and controls in place. The accountant is the member of your team who's going to help you do all of that so that you can efficiently and effectively run your organization. Most of you went onto the board of your organization to do great things in your community. You didn't go there to do accounting. You didn't go there to set up systems and controls. So my advice is always, it's an investment. Pay a professional. Even if you don't need an audit, get a few hours of advice on how you should be doing things. You're going to make better decisions. You're going to protect yourself better from things like the F word, fraud. And you're going to be able to grow your organization more effectively if you have all of that in place, and a professional is the one to do it.
I think that's a great answer, Jean, because the cost of not having the good advice and systems in place is really important too. So, and you mentioned previously the risk to the directors personally as well. So,
yeah, for sure.
There are lots of other questions, but some of them are quite specific to an organization, and I think it's better if we follow up with them individually. So, thank you again, Jean, for the presentation. And I think we have about a 5-minute break before the next session. Thank you.
Great. Thanks again, everybody. Enjoy the rest of the day.
Thank you.